All right, everyone, let's dive right in. Today, we're going to pull back the curtain on a process that is, and I'm not exaggerating here, the absolute bedrock of all financial accounting. We're going to explore how a business takes all the messy, raw data from its daily activities and transforms it into something structured, something that you can actually use to make smart decisions. We're talking about the journey of information from the journal, which is like the business's daily diary, to the ledger, which is its organized encyclopedia. And the bridge between them is a crucial step called posting. Now, posting might sound like a simple clerical task, but as we're about to see, it's the engine that powers literally everything in finance. Understanding this isn't just about accounting, it's about learning the language that businesses actually speak. So, to make this real, let's start with a simple, everyday scenario. Picture a small bookstore. Someone walks in, buys a graphic novel, and pays $20 in cash. Easy, right? Seems tiny. But in the world of accounting, that simple exchange is what we call an economic event. It's the first domino to fall. The entire complex system we're about to walk through is designed to capture this one $20 sale, sort it, file it, add it up with thousands of others, and present it in a way that helps a manager answer really important questions. Questions like, hey, can we afford to hire another person? Or should we order more of these graphic novels? So let's follow the money, all $20 of it, and see how it becomes a key part of the bigger financial picture. Okay, so the sale happens, a customer gets a book, and the store gets cash. An exchange of value has officially taken place. For an accountant, this is a trigger. This is the moment our work really begins. We're not just counting money. We are the official storytellers of the business's financial life. And this is the first sentence in a brand new chapter. Now, here's something that's absolutely critical to get your head around. The system doesn't care about the size of the transaction. A $20 cash sale and a $20,000 purchase of new shelving, they both start their journey in exactly the same place. They are both economic events that kick off what we call the accounting cycle. The process is the same every single time without exception. And why is that so important? Because it ensures that the financial records are complete, they're consistent, and above all, they're reliable. The number one rule is this: if it affects the company's finances, it has to be captured, and it has to be captured correctly. So we have our $20 sale. Where does the information go first? What's its first official stop on this journey? It gets recorded in a place called the General Journal. This is what accountants call the Book of Original Entry. Let's take a closer look at what that really means. The diary analogy is perfect here, because that's exactly what the journal is. Its main job is to record every single transaction in chronological order. That is, in the order that they happened. So on January 10th, you'll see our book sale. Right below it, on January 11th, you might see a payment for the electricity bill, and on the 12th, a purchase of new inventory. There's no attempt to sort things by type yet. It's just a running, day-by-day history of everything the business did financially. This chronological record is so important because it creates a complete, unbroken story. If you ever need to know exactly what happened on a specific day, the journal is where you look first. And here it is. This is what the actual journal entry looks like. This is the grammar of accounting, so let's break it down. You've got the date, which is obvious. Then you have the accounts that were affected. And notice there are two of them, cash and sales revenue. This gets us to the absolute core principle of all modern accounting, double entry bookkeeping. Every single transaction has to affect at least two accounts. Now let's talk about debit and credit. This is a huge stumbling block for students. Forget what you think these words mean. They do not mean good or bad. In accounting, debit simply means left side and credit simply means right side. That's it. The rules for how we use them come from our fundamental accounting equation. Assets equal liabilities plus equity. So cash is an asset. The rule for assets is that they go up with a debit. We got $20, so our cash went up. That's why we debit cash. Sales revenue is part of our equity. The rule for revenue is that it goes up with a credit. We earned $20, so our revenue went up. That's why we credit sales revenue. And look at the beautiful symmetry. Total debits, $20, equal total credits, $20. It always has to balance. This one little entry now tells the complete story of that sale perfectly. Okay, so this chronological diary is great, but it has a massive problem. Imagine your manager comes to you and asks a very simple question. Hey, how much cash do we have right now? To answer that using just the journal, you'd have to go back to page 1 and manually read every single entry, adding up all the cash that came in and subtracting all the cash that went out. I mean, for a real business, that's literally impossible. It's just not useful for making decisions. We need a way to summarize all this data. And that is precisely the job of the general ledger. So if the journal is the day-by-day diary, the ledger is like a set of neatly organized file folders. You'd have one folder just for cash, another one just for sales revenue, another for rent expense, and so on for every single account the company has. The ledger takes all that chronological data from the journal and reorganizes it by account, by topic. This is the game-changing step, where we move from just recording data to actually organizing it. And this process, this physical act of transferring the debit and credit information from the journal's diary pages into the ledger's organized folders, has a special name. We call it posting. Now look, in any modern company, a computer does this instantly. You type in the journal entry and poof, it's posted. But it is so critical that you understand what's happening behind the scenes. Posting isn't just copying and pasting numbers. It's the step that actually updates the running total for every account, making our financial data come alive so we can finally analyze it. So, we get the what and the why of posting, but how does it actually work? Let's get into the mechanics of how that info moves from the journal entry to the correct ledger account. It's really just a two-step dance. Step one is the transfer itself. You take the $20 debit to cash from the journal and you write it on the debit, the left side of the cash account in the ledger. You take the $20 credit to sales revenue and you write it on the credit, the right side of the sales revenue account. Simple. But step two is the genius part, and it's all about integrity. We create a reference, an audit trail. In the ledger, we jot down the journal page number, so we know where the entry came from. And back in the journal, we note the account number it was posted to. This creates a two-way link, like a set of breadcrumbs. It means that anyone, a manager, an auditor, can trace any number in our final reports all the way back to the original transaction it came from. This is how you prove your numbers are accurate and prevent fraud. Let's see this in action. Here's what our ledger accounts look like before we post our $20 sale. On the left, you see the cash account, often shown as a T account because it looks like a T. It's got a starting balance of $500. On the right, we have the sales revenue account with a balance of $3,000 so far. This is our starting point. And here it is after posting. Look at that. We take the $20 debit from our journal entry and add it to the left side of the cash account. The new balance? The old $500 plus our $20 debit gives us a new up-to-the-minute balance of $520. We do the same for revenue. The $3,000 balance plus the $20 credit gives us a new total of $3,020. Just like that, our ledger now reflects the current financial reality of the business. This happens over and over, all day long, keeping those balances perfectly current. So, we've walked through the whole mechanical process, from a customer handing over cash to updating a ledger. But the most important question you should always ask in a business class is, so what? Why do I care? This next part is the answer. This is the payoff. This is why all that meticulous detail is absolutely 100% non-negotiable for running a successful business. Let me be as direct as I possibly can be here. Without the posting process, you cannot create financial statements, period. It's impossible. The income statement, which tells you if you're profitable, you need the final balances from your revenue and expense accounts in the ledger to build it. The balance sheet, which shows the financial health of your company, that's built from the asset, liability, and equity account balances in the ledger. A journal is just a long, messy list of data. The ledger is where that data gets organized and starts to have real meaning. So the real power of posting is this. It's the bridge that turns a historical diary into a dynamic, real-time dashboard for your business. It gives you the current accurate balance for any account at any time. It takes thousands of chaotic little data points and sorts them into buckets you can actually analyze. And most importantly, it creates that solid foundation of reliable numbers you need for every single report and, ultimately, every single smart business decision. It's what separates guessing from knowing. Okay, let's put you in the manager's seat for a second. You're in a meeting. Your team wants to buy a fancy new espresso machine for the bookstore's cafe. It costs $5,000. It's a great idea, they say. It'll boost sales. Before you can even start talking about return on investment, you have to answer the most basic question on earth. You turn to your accountant and ask, how much cash do we actually have? Not last week's number, right now. Where does the accountant look? They look at one place, the cash account in the general ledger. And because every transaction, including our little $20 sale, has been posted correctly and is up to date, they can give you a clear, confident, immediate answer. In our little example, that answer is $520. Now that $5,000 decision about the espresso machine, it suddenly becomes incredibly simple, doesn't it? The answer is no, not right now. That right there, that is the power of having accurate, real-time information. It cuts through all the noise and gives you clarity. So I'll leave you with this final question to think about. We've just traced the perfect journey of one $20 sale. But what happens if a mistake is made? What if a journal entry never gets posted? What if it gets posted to the wrong account? Well, suddenly the cash balance in the ledger is wrong, and the decision about that coffee machine is now based on bad information.
There's a saying in computer science that applies perfectly here: garbage in, garbage out. If the basic data you put into the system is garbage, then every report, every analysis, and every big strategic decision you make based on that data will also be garbage. Ensuring the integrity of this journey from journal to ledger isn't just a low level accounting task, it is the foundation of sound business leadership.